Welcome to the video. Today we will break down the critical mistake of ETF overlap, why it adds no value, and how to simplify your portfolio without sacrificing global diversification. We will use practical examples like VTI versus VOO and VXUS versus VEA, and then show a professional Grade 2 fund structure you can implement. Along the way, we will test your understanding with quick quizzes and finish with a clear action checklist. Let us begin by outlining our agenda. Here is the plan. First, we will define ETF overlap and why paying for complexity reduces clarity and efficiency. Next, we will address the common U.S. market trap of holding both VTI and VOO. Then, we will extend the same principle globally by comparing VXUS and VEA. After that, we will build a professional two-fund portfolio that cleanly separates U.S. and international exposure. Subsequently, we will walk through a step-by-step audit to simplify holdings. We will include quizzes to check understanding and finally summarize the key points before wrapping up. Before we continue, a quick disclaimer. This video is for educational purposes only and is not financial advice. Investing involves risk, including possible loss of principal. Always perform your own research and consider consulting a qualified professional who understands your specific situation. Many investors unintentionally pay for complexity by holding overlapping ETFs. Overlap happens when multiple funds in your portfolio own many of the same underlying stocks. This redundancy does not improve expected returns, but does make rebalancing and monitoring more complicated. The simplest path to broad, low-cost exposure is often the best. Let us define ETF overlap. A total market fund owns essentially the entire investable market for its region, while a segment fund focuses on a subset, like large caps or developed markets. When you hold both the total market fund and one of its major segments, you are doubling up on the same underlying stocks. The diagram shows VTI as the total U.S. market. The S&P 500 universe sits inside VTI. VOO tracks the S&P 500. If your portfolio holds both VTI and VOO, you are adding redundant exposure and not increasing diversification. This redundancy complicates rebalancing and can increase costs without improving expected outcomes. Here is the key U.S. point. If you own VTI, the total U.S. stock market, you already hold the S&P 500 companies within it. Therefore, adding VOO on top does not add new exposure. It is like buying an entire pie and then separately buying the largest slice from the same pie. This does not increase expected return and can make rebalancing more complicated. The simplest approach is to own VTI for U.S. exposure and avoid stacking VOO on top. On the left, we have a redundant mix using VTI plus VOO. This configuration double counts S&P 500 holdings, requires more trades to maintain a target allocation, makes tracking weights harder, and can increase all-in costs. It does not add meaningful diversification. On the right, we have a clean setup using VTI alone for U.S. exposure. This consolidates the entire U.S. market into one position, reduces the number of trades, improves clarity of allocation tracking, and often lowers the overall cost without sacrificing market coverage. Internationally, the same logic applies. VXUS represents the total international stock market, which includes developed markets like those tracked by VEA, as well as emerging markets and often international small caps. If you hold VXUS and VEA together, you are overlapping holdings, not adding diversification. To simplify and maintain full global XUS coverage, consolidate into VXUS. This flowchart shows the two-fund portfolio blueprint. The investor allocates to two core funds, VTI for the entire U.S. market and VXUS for the rest of the world. The allocation between these two funds is the primary strategic choice. Commonly it's 70-30 or 60-40 splits between U.S. and international. A rebalancing loop returns weights to their targets periodically. This design provides broad, low-cost, global coverage with minimal moving parts, enabling straightforward management and clarity. This pie chart illustrates a simple target allocation of 70% U.S. via VTI and 30% international via VXUS. Your chosen split should reflect your risk tolerance, home bias, and investment policy. Rebalancing can be done by time, for example quarterly or annually, or by thresholds, such as when weights deviate by 5 percentage points. New contributions can be directed to the underweight side to help maintain targets with fewer sales. Here are the steps to audit and simplify your holdings. First, list all your ETFs with tickers. Next, classify each ETF as either a total market fund or a segment fund. Then, map segment funds to the total fund that already contains them. After that, select a target US to international ratio, such as 70-30. Consolidate by preferring VTI for US exposure and VXUS for international exposure, eliminating redundant segment funds. Use new contributions to rebalance first to reduce the need to sell, and be mindful of taxes, fees, and trading costs. Finally, document your rebalancing policy, including timing, thresholds, and the accounts you will use. This table compares a redundant mix against a consolidated approach. The redundant mix uses more funds, requires more rebalancing trades, reduces clarity when tracking allocations, and frequently results in higher all-in costs. The consolidated approach uses fewer funds, reduces rebalancing activity, improves clarity, and often lowers overall costs. Quiz time. Question: if you already own VTI for US exposure, what does adding VOO typically do? Option A, adds new diversification and boosts returns. Option B, introduces redundancy with overlapping holdings. Option C, neutral effect. Option D, protects against market downturns. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is that it introduces redundancy with overlapping holdings. VTI already includes the S&P 500 companies that VOO tracks, so owning both double counts the same exposure and does not add diversification. Second quiz question: which statement is most accurate about VXUS and VEA? Option A, VXUS is a segment of VEA. Option B, VEA is fully contained within VXUS's developed markets coverage. Option C, they have zero overlap by design. Option D, both exclude developed markets entirely. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is that VEA is fully contained within VXUS's developed markets coverage. VXUS is a total international fund that includes developed markets as well as emerging markets. Here are the key points. Total market funds already include their large segment funds. VTI includes the S&P 500, which makes VOO overlapping if held together. VXUS includes developed markets, making VEA redundant when combined with VXUS. A straightforward two-fund core using VTI and VXUS provides comprehensive global equity exposure. Choose a clear US to international split and rebalance with discipline. Reducing redundancy can lower costs and improve clarity. To wrap up, start by identifying any overlap in your current ETFs. Consolidate your US exposure to VTI and your international exposure to VXUS for broad coverage with fewer moving parts. Set a target allocation between US and international and automate contributions to stay on course. Rebalance on a schedule or threshold basis and keep the process simple. Thank you for watching. If this video helped, please like, share, and subscribe for more straightforward investing content. Let us know in the comments what overlaps you discovered in your own portfolio and how you plan to simplify. See you in the next one.